Hey everyone, how's it going? It is 10:02 a.m. Pacific on March 3rd. This is going to be both a recap of what happened on Friday and a weekly market review. So on Friday, I missed the aftermarket session because of meetings that I had. So we'll both take a look at Friday and recap the entire week. Okay, so let's go ahead and take a look at overall the markets. And we poked above this psychological resistance number 2 on Friday. We actually had a really strong day on Friday. And we were saying how this psychological resistance might hold, and it did twice. But on Friday, we broke through, and we broke through with quite a bit of strength. What we want to see here now is for that strength to continue and not just fade away, because this could be a bull trap. Excuse me. I would be a lot more wary if we had a larger volume bar here and a larger bar right here. Then it would look a lot more like capitulation. And if we get capitulation, then we would have the pullback. But right now, given that this average or the volume is only at the average, then we can't really call this capitulation. So what we want to watch for very carefully in the next week is, do we get a large surge in volume and an associated price movement? Either a bar like this, a doji candle, where is it? Like this, or like this, or like this, or a long bar. So this is somewhat average bar, what we got on Friday. What we want is a long bar like this, or like this, larger than average bar, long bars like these. So if we get either of those two anytime in the next coming week, then we're going to be very wary of that pullback, because what would happen is that this is such a strong bull market, and we just keep making all-time highs. At some point, there's going to be a large number of people be like, okay, fine, this market is going up. I was a bull. I've been really negative. I've been calling for a recession for the last year or two. I've been one of these people who just kept on believing that we were going to fall back. In November, I thought we were going to pull back. And then in December, I thought we were going to pull back. And then in January, I thought we were going to pull back. Then in February, I thought we were going to pull back. And now finally, we broke an all-time high again after, that's how many times in the last 3-4 weeks? Probably 3 or 4 times, 5 times in that many weeks. Finally, fine. I'm going to believe that this market is going to go bull. And so I finally go bullish. There's going to be potentially a lot of people with that feeling in this upcoming week. That's going to show up on this chart as a large green volume bar, maybe like this one or this one. The associated, either we get this huge surge upwards, or we get a surge upwards and then it pulls back down in the same day. And that's going to be an indicator of we've capitulated, and we've basically, all the last holdouts of people who didn't want to buy have now bought, which means the market makers have unloaded their inventory. They can unload their inventory to those people, and that's when the market can really start falling. If we don't get that, so the opposite scenario would be we just get average or below average volume bars throughout the next week, and then we would want to see what happens with price action. If all we get is a bunch of average or slightly below average volume bars and we creep sideways, then that's consolidation. We have to wait and see what's going to happen. If we go upwards, then that's a real continuation of this uptrend. And if we trickle downwards and start challenging this trend line again, and then we would have to evaluate when we come and we touch the trend line, either this EMA 20 or this line that we've drawn. And pretty much for the last several weeks or 2 weeks, they've been the same level. At some point, they will start to deviate from each other. And then we'll have two support levels, but right now they're the same support level. So this next week is going to be very, very critical to watch. We want to evaluate very carefully and watch the volume very carefully. Right now, other indicators aren't going to be very helpful to us. RSIs are probably telling us, hey, we're overbought, but they told us we were overbought over here too. They told us we were overbought over here, told us we were overbought over here, told us we were overbought over here. But every time that RSI pulled back down, did we get a pullback? At worst, we got this one down into the EMA 20, which is nothing, 2-3%. That's not a real pullback that we're concerned about. That is still a continuation of the trend. So what we want to see, so we don't want to use indicators in this particular instance, because they're not going to tell us. They're not going to indicate very much for us. What we want to see is that volume, either spikes in volume and price surging upwards, and then either just surging upwards, in which case we would expect it to pull back the next day or in the next couple of days, or price surges upwards and pulls back in the same day, in which case we would continue that pulling back to continue to happen. If we get nice and steady volume or average volume or below average volume, then we would say, what direction is price moving? Is it slowly moving upwards? Is it going sideways, or is it moving downwards? And then we will plan our positions going from there. So right now, we will want to watch very, very, very carefully. We don't want to make huge decisions on our portfolios, or we don't want to make single trades that represent large portions of our portfolio, because right now is a period of uncertainty. It looks like it's very strong, looks like a continuation of the uptrend, and we poked above this psychological resistance. But remember, the psychological resistance, especially because we have no history ever of being at this price, it is a zone. It is not an exact level. So when I say 510, that 510 could encompass like 510 to 513, 515. It doesn't have to be 510. So 512.85, which is where we closed at, that is within the zone. We don't want to say, oh, it popped above 510. Here we go. We're going to keep on going upwards. It's no, we poked above 510, and now we really need to watch and see what it's going to do. Okay, so let's take a look at QQQ. QQQ, very similar, except it is significantly above this horizontal resistance that we were at before. So that is a stronger move upwards. But again, we're only at average volumes. So we haven't had capitulation yet. We cannot call this a top yet. It could be, but it could also be a continuation of a trend. We just don't know yet. So basically what happened was we pulled back into the EMA8 and we bounced off of it. And we bounced off of it pretty strong. It has the potential to go parabolic. And if it goes parabolic, that's a sign of it topping. But also, if we get that surge in volume, like this one, that's a sign of it topping. This one was not, because we had this huge volume bar, but it wasn't at a high, and it didn't move the price that much. We want to be very careful. We want to watch for, I probably won't be able to find a recent example. So over the last month or so, we've had the beginnings of parabolic movements before, like this right here, like this right here, like this right here. They're just a few bars into the parabolic movement. And then it just keeps on either consolidating, pulling back and going back up, or it's very slowly moving upward after that consolidation period. So it doesn't mean that we have to pull back and we have to pull back through this uptrend. It could just mean that we do what we did over here. It could be a continuation. And again, that volume and price behavior is going to give us the best clue possible for how that is going to develop. Right now, we don't have enough information. We only have enough information that we want to be careful. So we'll look at Dow Jones. Dow Jones, not the same story at all. Yes, we're higher, but we're not even at the all-time highs. We didn't come and touch these highs over here. We're actually still below it. So same thing, we came and touched that EMA 8 and floated above, but all that movement in the markets, it was heavily tech, looks like. We'll confirm in just a moment, or at least heavily consumer discretionary tech. So the blue chip stocks participated, but not nearly as much as the tech stocks, the discretionary stocks. So we want to see that separation. We want to see how that sector, how those sectors played out. Before we do that, let's take a look at TLT. I want to look at VIX. We'll look at the put to call ratio as well, and we'll look at market internals and momentum, and then we'll look at the sectors. Okay, so let's take a look at TL. Oh, actually, let's look at small cap stocks, because that could be really interesting. If small cap stocks are breaking out, then what we'll want to see is when do small cap stocks start leading the large cap stocks, and then that'll be a real bull market. So if we look at IWM is challenging this resistance. So not quite, it poked its head above this horizontal line, but again, those are regions. So we're at a deciding point for IWM as well. Is it going to pull back again into this channel, or is it going to break out? If it breaks out, then what we want to see is when does it start leading the large cap stocks. But this is the first requirement in order for us to go on to that bull run, large, like real bull market run. But we're not sure if this is going to play out yet, because it could just fall back down. We'll have to see. Take a look at TLT. TLT also poked its head above this horizontal resistance right here, but we have that MA200 and the MA50 right above it. So I'm not going to get too excited about this. If it does go and it does break through both of those, that would be very bullish for the markets. So the scenario that we're looking at, the potential scenario that we're looking at, is this: we break out above the MA200 and MA50. We see small cap stocks breaking up as well. The SPY and the QQQ have a steady movement upwards, not a parabolic movement upwards. And then that would be a signal that we're continuing this uptrend. And if slowly IWM overtakes the S&P 500 or the QQQ, then we shift into a true bull market, and everything keeps on going. This keeps on going. So it will invalidate the things that I said about market makers running out of money or running out of inventory. Yeah, we're running out of money and inventory. So what that would indicate, though, if we're wrong about the market makers and where they're at in the position of their supply, then that would imply that a lot of money came into the markets. Sort of like what we were saying after COVID. A lot of money came in after COVID, which is why we could able to go on this huge extended bull run. Well, so far right now, this is a normal length of a bull run. And if it is able to continue longer, and it's significant longer, which would be indicated if the IWM surpasses the S&P 500, then that would imply there's a pool of money coming into the markets from somewhere. And we would want to know where that pool of money was. So, or they're just a whole bunch of portfolio managers sitting on cash and not participating in this bull run right here because they're waiting to see if the economy was really going to deteriorate, or we're waiting for the Fed, or maybe the Fed starts cutting rates right here or sometime soon, sooner than we anticipated. So they start cutting rates in March, even though we only have a 2% chance of it. Okay, I guess 4% chance now. What if they do? Well, that's going to be completely against market expectations. We get this 4% scenario, and the markets just go on a tear. Okay? Even if we do it in May rather than March, still markets are expecting 74% chance that nothing's going to happen So this is the lower probability event actually happening, then markets go on a tear. So all the money that was locked up over here or invested over here, or we had pools of money that weren't being invested, suddenly come into the market, and then this can extend into a long bull run. Well, we don't have to get that 5 to 10% pullback now or imminently. It's just that over the last few weeks, it seemed like it was imminent. Right now, we're looking at the possibility that it's no longer imminent, that it might be pushed further down the road. We're not sure yet. We're right now, whereas before I was at maybe like 80 to 90% that we might get a 5 to 10% pullback in the next, just say by the end of March. Right now, I'm 50-50 because this market has proven to be so strong, and there is that potential of a shock move by the Fed, then this could extend. And there could be political reasons for that too. Biden says, hey, you got to get me a better platform to stand on for re-election. And he applies pressure to start lowering rates. And we go on this giant bull run. That's a possibility as well. So there are right now, because it's an election year, there are a number of forces, non-market forces, that will try to exert influence on the market. And that could send us temporarily in directions that we're not expecting. So right now I'm about 50-50 in terms of whether or not we continue this uptrend or we get a pullback. And exactly as I started out this video saying, was it's going to depend on how the volume plays out over the next week and how the price action plays out in conjunction with that volume. So again, we want to watch this particular week, upcoming week, very, very carefully. If I'm positioning my portfolio, I'm still positioning it to the upside, and I'm going to be very careful in the sectors that I'm choosing. We'll go over the sectors last. So VIX is down lower than it's been in several weeks, maybe 3 or 4 weeks. So that might be indicating some positive news for the market. So market makers are not as nervous, and so they're not pricing in as much volatility as before. So that is a slightly positive sign, at least from the position of the market makers. They're not thinking that there could be a lot of volatility, and that bodes or indicates that market makers believe, at least for now, that markets could move steadily upwards. CPC at 0.97, so almost perfectly equal between puts and calls, so that's absolutely neutral, not telling us anything. I'll take a quick look at this fear and greed index, and we're still in extreme greed. So how long can we stay in extreme greed? Well, if money comes into the markets and the overall market cap of the S&P 500 increases, then we could stay here. Normally, extreme greed cannot last for a long time, but if money is coming into the markets, then it could stay there for quite a while. When that happens, though, we want to be careful, because that's an indication, that's normally what we call a bubble. A bubble starts to develop, and at some point that bubble pops, and then we're not looking at a 5 to 10% pullback anymore. We're looking at a potential for full-on bear market, so 10 to 20% downward or more. So the longer this goes without a pullback, without that 5 to 10% correction, the more likely it is that when we get that correction, it's going to exceed 10% and maybe even exceed 20%. So for this to be a healthy bull run, we really do want to see that pullback, that 5 to 10% pullback. Where again, every year we expect 2 to 3 5% pullbacks and 1 10% pullback in a normal bullish year. So far we've gotten 0. Of course, this year is only 2 months old, but if we start from the beginning of this bull run, which is roughly October, end of October, Now we're at 4 months old. And we just really want to see, at the very least, like I say, 4 months old is 1/3 of a year. And in 1/3 of the year, I should have expected a 5% pullback within that. Remember, if I have 2 to 3 5% pullbacks, okay, and I've gone 1/3 of the year, I should have expected to see a 5% pullback by now. And we haven't. So at some point, if we don't get that 5% pullback soon, then we're looking at an increased possibility of a nice bull run, but after that, a bearish market like this. So for this to be lasting, we would prefer to get that 5 or 10% pullback sooner rather than later. Otherwise, that pullback could turn into a bear market. But that could be indicated because with all the forces that we have right now, normally we have inverted yield curve, which indicates recession in the next 2 years normally. And the downward movement of that market is usually triggered or stimulated, not the recession, but the market. So remember, the economy and the stock market are two different things. They're not the same thing, and they are out of phase with each other. The stock market leads the economy. So normally when the Fed starts to pull back on rates, that is an indicator of the beginning, the very, very beginning of a pullback or a bear. It's short term, it is bullish, but it indicates that a pullback, a deep pullback, 10% or 20%, I guess I can't call that a pullback, a bear market is imminent. It tends to happen in the months after the first initial rate cut. And then the potential for a recession. If they had pulled back during a stronger economy, meaning that, and we didn't have an inverted yield curve and they started to cut, then that we wouldn't necessarily expect a recession to follow. But because we have that inverted yield curve, then if they start cutting now, then we expect the recession to follow. And we have indications of that worldwide, where Germany, the largest economy in Europe, is not doing very well. We've got lots of data over the last month where Germany is really starting to struggle. China is struggling, has been struggling with their real estate, with a whole bunch of, like, their entire markets have been down. If I look at FXI, you see that they've been on this bear market since the beginning of 2023, and the Chinese government has been trying to do stimulus, but it hasn't changed any of it. We are in this bear market. So globally, we're starting to see pressure, and we're starting to see bear markets develop around the world, and recession or economies starting to struggle. And the US is probably, right, not going to be able to sustain this against all of that for very long, because we are in a global economy now. The United States is not isolated by itself. The only thing that's driving this up was the Magnificent Seven, the AI revolution. Some people will say, well, AI is long term and it's going to create a lot of benefits and it's going to create economies and it's going to create all sorts of stuff. And the answer is yes, that's true. But it's over a very long term. That doesn't mean there's going to be zero pullbacks and zero bear markets in this longer term view. And some people think AI is a bubble, and for sure AI is a bubble. Doesn't mean it's going to pop right now. It only just started inflating. We're probably going to see it pop in 5 to 10 years, not in 1 year. So this upward movement can keep on going. Yes, there are things that are growing the GDP, which means that the S&P 500 does have room to grow and more money is coming in. But we do have to account for that things don't move up forever. And the natural rhythms of the markets is pullbacks, corrections, and sometimes even bear markets. So we want to be prepared for that. Again, at this moment, we're at about 50-50 from where we are, and we really need to see how this next week develops. If I look at market internals, market momentum, so let's take a look over here. market momentum. Okay, I've got 55% of stocks above their 50-day moving average. So slightly higher than before. We were looking at like 53, 54% before. 60% above their 200 MA. I think that number has come down. Let's see if I can look on a chart. Down from here, up from January, up from January, down from December. Okay. So not seeing too much of interest on the 200-day. On this 50-day, let's take a look. Okay, we had this spike right here, and then at these spikes, we expect to pull back to about 30, 40%, sometimes lower. We got down to 53%. So it could come even lower, down to this 40 to 30 range. It would be a very strong market and a lot of money moving into the market if we just went up from here. That would be the less normal case. I guess this one. But even after it popped up a couple months after that, it did still hit that 35. So it's sort of like a head fake right there. So at some point, we probably are still expecting to come down to this 30 to 40 region. So that indicates that we still have a strong possibility of a correction or a deeper pullback. So it's just a matter of when. Does it happen now starting in the next 1 to 2 weeks? Or does it take a couple months to develop like this one did? It took a couple months to develop. So if it takes a couple months to develop, then we can continue moving in this uptrend for a couple months and then have our correction and pullback. Or we start to see signs of this topping over the next week, and then we start to pull back in the week after that, sometime in the next 2 weeks. So that's what internal markets and momentum is telling us. So we're still going to expect that pullback or correction. It's just the timing of it may be pushed a little bit further out. I look at S&P 500 now, 68% above the 50-day moving average, so that is definitely up. So when we were up here, we're at about 90, pulled back down to about 63. Now we're at 68. When we hit 90, we expect to hit 30, 90, 30, 40, 35, I guess. So between 30 and 40. But sometimes we bounce back up and take a couple months to hit that lower number. So that's kind of what this is looking like. We bounce back up and either we turn back down from here or we allow it to go up a little bit further for another month or so, and then we pull back down. There's no avoiding the correction. There's only pushing it back and delaying it. So again, this internal picture is giving me a clearer idea. So we're on 50-50 on it happening imminently, 50-50 on it happening in the next 2 weeks, 3 weeks, almost 100% that's going to happen within the next 2 months. So this internal analysis is giving us more clarity. So given that, we're not too sure if it'll happen in the next 2 to 3 weeks, but we are very sure that it'll happen in the next 2 to 3 months. How do we position ourselves? Well, we still want to position ourselves upwards, because if it's in the 2 to 3 month time frame, we definitely want to be pointed upwards. If it's a 2 to 3 weeks time frame, then that's a little bit trickier. So we want to be prepared for both instances, and we are in this upward movement, this uptrend, so we still want to be pointed upwards. So I want to protect myself, or I want to minimize my exposure to risk in the next 2 to 3 weeks, though, as we're deciding whether or not we might have a pullback sooner rather than later. So we want to be careful in our sectors. And we went over sectors that I liked over the last few pre and post market videos, but let's take a look again and just make sure nothing changed over the last trading session on Friday. So definitely on a longer term, tech is leading, but we would expect tech to lead on the way down as well if we get that pullback. Why? Because think about how much money was put into NVIDIA over the last 4 months and how much money people made over here. If we start to pull back, this is where people are going to take profits. They're going to take profits in NVIDIA and in names like NVIDIA where they made a crap ton of money. So people made, or it doesn't matter if they're retail or institutional, if we made 106% in the last 4 months on the stock, forget about options. If I made over 100% on the stock, then I probably made between 300 and 1,000% on the options. And if we made that much money and we start to see the pullback, this is where we're going to take profits, where we're going to protect the 106% instead of something that only made like 10 or 20%. You're going to take your profits off the table right here. So all these big profits that were made over the last 4 months, they've all been in tech. If I look at XLK, the sector ETF, XLK made 32%. And if I just look at the SPY, let's see, SPY made, I always have trouble with that line being in the way. SPY made 24%. So the tech sector outperformed the index by 10%. So the profits are heavily inside the tech sector. And so if we're going to take profits, we're going to take profits out of the tech sector first. So if we're going to point our portfolio upwards, we definitely don't want to put it in the tech sector because that's where we expect the profits to be taken out of first. Where are we going to take profits out more slowly? Well, those would be the more defensive sectors. In fact, some people may be taking profits out of the tech sector and putting it into the safer sectors. So that hit our radar screen on either Friday or Thursday was ITA, actually aerospace and defense ETF. Okay, so this is still looking pretty positive. I would be okay with going long some stuff in aerospace and defense. And let's look at the other sectors. On a shorter term, maybe 1 month basis. Actually, I should just look at the charts. I shouldn't even look at. Okay, so not semiconductors, because that would be tech. Home builders is interesting. Let's see how much home builders made it during this period. %50. So I would expect money to leave home builders as well, to be profit to be taken there. Retail is similar to consumer discretionary. Industrials looks good, but it looks like they made a lot of money here too. 26%. Okay, so in line with the S&P 500. So I would say neutral, so on the XLI. Let's look at materials. Materials is one that we've been looking at a lot over the last week, and one that I've liked quite a bit because it did have this pullback. So if this is what we wanted to see in the overall markets and we just did not see. See, this is a pullback 6%, almost 7% pullback right here. That's exactly what we wanted to see for a healthy move upward. So the fact that we saw it in XLB is very, very encouraging. It's underperformed. It's at 18% rather than 24% versus the S&P 500. And normally you're like, well, you don't want to be in the weak sector, but this sector is weaker because it had that healthy pullback and it bounced off of its MA 200 and started going up. This is actually looking really good. This is my favorite sector so far that we've looked at. This is looking very good. Not to say that it won't pull back if the entire market pulls back, but it wouldn't pull back as much. It would be stronger. It's relatively strong to the market, even though it's underperforming right now, because it had that healthy correction already or pullback. I guess, yeah, a little over 5 to 10% would be in correction territory. So this is really enticing to me. And then let's see if there's anything else. ITA did have a pullback as well. So even though it has matched the S&P 500, it did have this pullback. It had a 6% correction. So ITA and XLB are looking great. XLV had this huge run upwards. It's probably outperforming or matching the S&P 500, but it did not have a pullback. So it hasn't matched. It's a little underperformed the S&P 500, but also did not have that pullback. So if I'm looking at this versus XLB, XLB had about 18, 19%. XLV went up about 20%, both safe sectors and both underperforming the overall S&P 500, but XLB had a pullback and XLV did not. So I'd be favoring XLB over this one. Financials, straight up. XLE not correlated. It's just been chopping sideways. It looks like it broke out though. So XLE, if we get follow through to the upside, I'd be paying attention to XLE as well. So XLE, if we get continuation, XLB, ITA. Gold looks like it might be having a breakout. It's safe sector for sure. We talked about earlier how we've been seeing money move into Bitcoin instead of gold, but if gold is starting to have some activity, gold has a tendency to trend for quite some time. If we have this breakout, what's this? Close, why don't I have, okay. This one closed at 192.59, high of 193.18. This one closed at 192.89, high of 193.40. I believe that's the all-time high. Nope. All-time high was back here in 2007, but we are very close to that all-time high. I'd keep a careful eye on gold. If gold breaks this high and then matches the all-time high and then breaks through that, it's time to pay attention to gold, which would indicate somewhat recessionary pressures. If gold starts making a run, that means people are really, really looking for a flight to safety. That's kind of interesting that it's happening at this particular time. That just gives me more confidence in in a pullback or correction or worse happening in the next 2 to 3 months. But this would not be imminent. This is not something we would add to our portfolio today. So I'll leave that off the table. XLE, if in the next week we pop above we stay above 87, we would definitely consider XLE or energy stocks. XLB is looking great, and ITA. So those are sectors that we'd be focused on. So don't be surprised if you see me focusing on these sectors in the next week, and either on example portfolio or example trades, or in actual class portfolios, you see me start adding in these particular sectors. So I think we got a really good idea of what's happening in the markets. We've got a pretty good plan of how we're going to handle it. We have a nice short-term view. We have a medium-term view of what's going to happen in the markets. For now, they're pointed upward. We're on this uptrend. It could extend for another 2 to 3 months, but after that, we have high certainty as of all the data that we're seeing right now that there would be a pullback or a correction, or maybe even more than that. But right now, I don't expect us to break the MA200. So I don't know if we'll get more than a correction. I'll just say down here, I guess that would be 12% as of right now, this moment. So I guess we could call that a little bit, or I would call that like a larger correction. I wouldn't really call it, it's definitely not a bear market. So that would still be a correction. So that's what we have. We have very high conviction that that'll happen in the next 2 to 3 months. But in the meantime, in the next 2 to 3 weeks, the next 1 week is going to be very critical in forming our opinion what happens in the next, just say through March. But what we're expecting, either we're going to keep on continuing, or we could still have a lesser pullback if we do pull back in March rather than in the summer. Okay. So are there any questions? We've got all good? Okay. All right, so we'll leave it there, and we'll be constructing our portfolios very, very carefully in the next week. Or I mean, it could be a time for you to just sit on the sidelines and just watch what develops, because we will have more certainty after another week of trading. Let's actually, before I go, let's take a look at the weekly chart. And this weekly chart is incredible, because look at all these green bars. There's, on a weekly basis, there's really only been one or two. So this, a small dip right here, this little pullback, and then this right here, which is just a sideways movement. That's an incredible run right here. So many weeks of just this strong bullish upward movement. So on the weekly basis, we're not even seeing any weakness. So we would just wait to see what happens over the next week. If we get sideways movement, then on a weekly basis, you can see that we're just starting to potentially chop through the uptrend arrow. We might just chop sideways through it and then suddenly be below the uptrend. So that doesn't really change our view much, but we'll have a much clearer idea in 1 week, and then we'll know for sure in 2 weeks. Okay. So it could be a good idea to just sit on the sidelines and watch what develops over the next week. Unless you have a compelling reason why you want to trade over next week, sitting on the sidelines is a perfectly valid move, especially in a week like this. Yeah. All right, guys. So since there's no questions, we'll leave it there. And this will be the video. It'll be a weekly market review, and it will also be the video for the Friday close. So you'll see it on YouTube. You'll see it in our own internal weekly market review videos as well. And for those of you that are available, I'll see you tomorrow morning in the pre-market session. Thanks, guys. Have a great rest of your